officially live on Facebook already. It is the Thursday edition of the Not Your Average Investor Show. You guys ready for it again? The GW Red Property of the
Week.
I'm your host, Pablo Gonzalez, my phenomenal partner in crime here, my co-host. He's often like business planning, strategic stuff. So in his place, we have the EY Entrepreneur of the Year Award just to hold a little weight, add a little credibility to this thing. As always, we have the always happy, always helpful, the magnificent Madison, our community manager. Say hello, Madison.
Hello, everybody.
And we got 3 guest investors today. I'm going to introduce the fairy godmother of our community, fresh off of a big success of getting her real estate license. She's in the middle of a blackout. There's like a rolling blackout happening in Monterey Peninsula. So she's going to be in and out today. She's on her phone. Jen Filzen, welcome, Jen. We got, you know him. He is the original poorly pronounced name by me. I used to have a reputation for a great name pronunciation until I ruined it with Herve Francois out of New Jersey. Say hello, Herve.
Pretty good. Thank you very much, Pablo. Much better pronounced, man. You've been working on it. I appreciate you. Thank you.
I've been working hard. I work hard every day.
I know. I think that was your 2022 New Year's resolution, and
check.
Let's see. Right.
And another guy that we met for the first time as a guest investor. Since then, I've gotten to know him. We got some coffee the other day when he was here in Jacksonville, looking at some other businesses he's got in town out of Atlanta. Bob Wiesner, welcome to the show, Bob.
Thank you. Good to be here. Happy to be participating.
Good to have you. Good to have you. Good to have you. And if you're watching on Facebook, if you're listening on the podcast, you're watching on YouTube at some point here in the near future, we love having you here on board. The best way to do it, though, is to go to nyais.com, register there, join, be part of this thing, ask some questions, be part of the chat, make a new friend. And if you do it right, you check in, you get to be part of the roll call. Y'all ready for the roll call?
Do it.
Roll call, everybody. We got our leadoff batter, John Henning, always in the house. Good afternoon, all. We got the MVP of the Not Your Average Investor Show community, Lee Bishop. We got Chris Gonzaga from the illustrious Hudson Valley. We got the ringmaster of the Not Your Average Investor Show community, Drew Barnhill. We got Marilyn Cotterman from Homosassa, Florida.
Manatees.
That's where you swim with manatees, people. It's beautiful. We got Leo Faraganan. Faraganan. He says it's going to be a rocking show. We got Pedro in the house saying, hey, welcome back, Pedro. Good to have you. We got Dean Curry. Good afternoon, everybody, from Columbus, Ohio. We got Eddie Harris from Atlanta checking in. Who else we got? We got everybody knows his name, Noah Randari. Hello, everyone. Greetings from California. We got Tony D in the house, Anthony Dita. Greetings, everyone. Who else? We got Jenny Berger from Chicago. I think that's a new name. That's a new name alert. New name. Jenny, welcome. Good to have you. You're joining us at a unique moment in the history show where we're trying something completely different. We got Aaron O'Neill, our favorite silent watcher that is now an active watcher and participator. Aaron, I will continue to say your name. Love to have you here. She's from Boston. We got Ken and Carolyn Moline, the patriarch and matriarch of the first family of the Not Your Average Investor Show. We salute you. They are returning from a trip to Oregon and Washington. I've heard that's a beautiful part of the country. We got Gregory Stone, the other Greg, part of our community. Welcome. We got Michael L. Noir joining us from California. Good to have you. We got Carlos Andres Lopez. He is back. How? We haven't seen you in a while, joining us from, I don't know if he's still in Lima, Peru right now. I know he's Peruvian. It makes me hungry just to say that because I love Peruvian cuisine. And I think we're ready to roll into it with my favorite segment. Madison shares good news. Tell us, Madison.
All right. I am going to take this time today to brag on my JWV team. They have hit some pretty awesome goals and have accomplished some really cool stats within the last few weeks. I'm going to start out with our renovations and turn team. They shared with us in our Tuesday morning meeting that they are averaging around 11-day turn time for a property, which is super cool for you guys, because that means that if a resident moves out, turn team's coming in and they're getting that home back on the market ready to get put back on the market within 11 days. Super cool. I think that's really impressive personally. And then once that home goes back on the market, our team has been seeing that when the new lease is signed, those homes are getting rented for around 18% more than what they were being previously rented for
Wow.
on the lease before.
Wow.
Super cool, means more money in y'all's pockets. And then I also want to shout out our leasing team. They rented 41 homes last week, which is a new JWB world record. So round of applause. Just love being a part of this team, honestly. It's just one thing after another. I'm always impressed with everybody. So that's some good news.
That is good news.
Yep.
I'm super impressed. So Madison, that's an 11-day turnaround. Is that what you said?
Mhm. Yeah, so they shared with us that when they go in between the scope and everything, they're averaging around 11 days.
Amazing. And then what was the percentage increase in rents? 18% increase in
right
rents.
now, an average. Mhm.
That's good news. That's good news. Hey, you know what? Let's just kick it over. Let's kick it over to the guest investor panel.
Mhm.
When you hear those numbers, how does that translate as a real estate investor? What does that mean?
Love it.
Jen loves it and she peaced out.
There she goes.
And she peaced out. Herve, what do you think when you hear those numbers? What's the first thing that's
Yeah, I'll give a response and try to stay. But no, listen, Madison, thanks for those stats. Those are great stats. I don't know, I don't know them on a comparison basis, month over month, year over year. At the end of the day, it sounds like things are going up to the right, which is where you want your numbers to be going on something like this. So look, in a market like this, all kind of volatility that you have, rents going up 18% once they're put back on the market, turns in 11 days, when we keep on hearing about supply shortages and labor shortages and so on and so forth, so that JWB can turn a property around in 11 days. Some properties, they just need, the paint and the cleaning of the floors. Some properties, they need a heck of a lot more than that. But if they're averaging 11 days, so in 11 days, you're back on the market. So you're not really, having to come out of pocket to pay mortgage, right, in 30 days, because it's not on the market for 30 days on average, less than that. And then, the 18% increase in rent. So I think it's tremendous. It really, really is tremendous. And I think in this kind of market volatility, it gives us even more comfort that we have our properties, that we have our portfolio being managed by JWB.
That makes a lot of sense to me. Bob, what do you think?
Well, when I hear that 11-day turnaround time, I've done a little bit of active management of some of my rental properties over the years. And I wish I could have come close to 11 days because mine was, triple that, normally. So, yeah, so I think that's fantastic.
That's awesome. Yeah, I agree. I think Cal put here in the chat that he got his fourth house rented in 14 days in a turnaround. That's pretty awesome. As you all know, I'm an investor in JWB and a client of JWB, just like the rest of you. And I know that I have a potential turn coming up in October, November. And I hear those numbers and I'm like, that means that my wife is going to be anxious for fewer days. Right. It's real, right? Like I think about it's the idea of like the experience of it has become very, very real to me right now that I'm going through a couple of things where I'm going through an eviction and I closed on a new property and I have a turn coming up. So like these crucial moments to me is what I have noticed that are kind of like the times that people decide whether or not they like this asset class. And I think minimizing those windows for me on a personal level, that's kind of where my head is at. I don't know if that makes sense. Jen, you've been investing with JWB for a long time. I'm sure you've had some turns. How does all that stuff compare?
I think it's wonderful what JWB is doing. The fact that their turnaround time is so fast is fantastic. I belong with a local chapter of the National Association of Remodeling Industry, and turnaround times for them are longer than 11 days. So the fact that JWB has everything handled in-house is exceptional, truly. I always know that JWB has my back.
Awesome. So I think right now that was a preview of kind of like the level of acumen here with our guest investor panel. Jen, while we still have you before the next blackout happens in Monterey, introduce yourself. How long have you been investing with JWB? How many properties do you have with them and any other real estate that you might have?
Sure. Originally from Jacksonville, Florida, live in Monterey, California. I've been a JWB client since 2012. We own 5 properties. And I'm just loving this community. You guys might know me as the fairy godmother of the Not Your Average Investor community because I can't help but want to put events together. So really, I only invest with JWB. I have money in the bank waiting to buy my next property. I'm just waiting on my taxes to get done. Yes, I'm still waiting on my accountant, but whatever. So once I get that figured out, it's either going to be buying another property or investing it in the private money lending program. So I'm excited to be with JWB, and I plan on being with JWB until death.
Very cool. Very cool. Glad we share two things. A, that I'm gonna plan to be here for a long time, and B, I haven't got my taxes done either. Don't tell my wife. All right. Bob, how about you, man? Introduce yourself. Give us kind of like a breadth of where, how long you've been a client, and also any other kind of like, what are you invested in these days?
Sure. So I currently live right outside of Atlanta. I've been here for about 4 years. Before that, I was actually a Florida resident for about a decade or so. And yeah, I've been investing in real estate for several decades in all sorts of different real estate. I've been a JWB client for a little over a year now. I bought 3 properties to start, and so far they've been going well.
Awesome. All right, cool. You own other businesses and stuff like that too, right, Bob?
I do. Yeah. Have several different things going on. Yeah. All different types of real estate, ranging from, commercial warehouse to multifamily to single family residential to other types of things, and a lot of non-real estate stuff too.
Yeah. That's why
I love business, so I do all kinds of them.
I know. I loved our conversation. Herve, give us a little background on yourself, my brother.
My man, appreciate it. So been with JWB now for really 4 years now. Started off similar to Bob, bought 3 homes with them 4 years ago. And over the past couple of years, because of the C3X method, was able to go ahead and build up enough equity, do a refi, and use the refi proceeds to buy 3 additional properties with JWB. So that's been going really, really well. So obviously when I was down there last time, I was able to go and, drive through, take a look at the properties, see the numbers every month, like I was saying before, up to the right, both on appreciation and on rents, above average. But, we'll take above average once in a while because, we know it's cyclical. Gregg's always talked about how cyclical it is and everything like that. So enjoying above average. But, when I know that JWB is working on my properties, my active stuff is I do work with a small real estate group in which we buy large multifamily apartment complexes. And then on the side, I participate in some syndicated offerings and just, and that provides some nice diversification outside of commercial and residential real estate. The residential, obviously, with JWB, investing in syndication office buildings and retail centers and so on and so forth. So, try to spread it out. But like I was saying before, definitely beginning to pick up the acceleration of paying down some of the debt on my JWB properties, implementing C3X even a little bit quicker, because just really want to start the cash flow to start growing.
Awesome. And you are a recovering Wall Street broker, right?
I'm still recovering.
Always.
I might be in stage 3 of the 9th step.
I love that. And listen, we're going to jump into the property right now. This is a unique thing, right? If you haven't been with us for many, many shows, we often will have one guest investor. Right now, having 3 guest investors with GREGG being out kind of allows the mice to play while the cat's away. So I really want our community, if you have any questions for any of our panelists or all of our panelists, as far as like their experience, why they would or wouldn't be buying more stuff, right? Like, let's get really vulnerable and nitty gritty here today and just give as much value as possible. That's what I would love to happen. And we can do more of these because I really like seeing all my friends on screen at the same time. And now we are gonna magically whisk ourselves away to the property here to 2215 Kistler's Ridge Way. It sounds like a romantic place, Kistler. Jacksonville, Florida, 32221. It's got a purchase price of $275,000. It's a 3-bedroom, 2-bathroom home. It is a new construction. This is a picture of like the model that it looks like. And right here, this is what we're all buying into, is this IRR of ROI of 11.83%. And normally this is where I kick it over to GC to see what he likes about this property. But because he's a very prepared individual, he sent me what he likes about this property. So I'm going to read this right here. What GC loves about this property: investing in below middle income neighborhoods equals risk mitigation. Medium home sales price in Jacksonville right now is $365,000. which is way up from recent history. And as prices continue to increase and interest rates going up, that pushes more buyers out of the buying pool and into the renting pool. And this is why investing in this below middle income housing is poised to win for both rent rates and home price growth, right? So if we're looking at this like $275,000 home, we are, almost $100,000 below the median of where Jacksonville is. What else we got? This is new construction, which equals a slightly lower maintenance and vacancy costs, right? You see that reflected here in the pro forma, and it's available and ready to lock in with today's interest rates, which, as we all know, are kind of freaking everybody out these days. So I think it's on an upward trajectory. So the ability to like lock in this house, this thing's about to be ready to be occupied. You can close on it soon, and it's a beautiful little ditty of a home. I guess I would go here now to. I'll go to, when we got Jen. So everybody knows Monterey Peninsula, the most beautiful place in the world where Jen lives, is having a power outage. So that's why she is in a unique situation. Jen, the number one thing you look at when you're looking at one of these performas, what are you looking at here?
I'm typical. I always look at the price first. Can I afford it? And then the next thing I figure out is what's the return on investment. So this looks beautiful. All the JWB houses are so cute. Seriously, whether they're renovated or they're new, they're adorable. I would move in.
That's a great data point. Herve, you're a seasoned real estate investor. What are you looking at first here? And are you thinking about moving into one of these homes?
Well, I don't know about moving into one of the homes, but definitely would. Let me see before I say definitely acquire. But yes, I mean, I'm liking the percentage. I'm liking the ROI of that 11.8. I'm liking a little bit blurry here on. Okay, so 1.1700 on the lease, on the rent. Yeah, no, you're good. Thank you. So that's good there as well. So yeah, no, I'm liking this. I kind of like the fact that it's me personally, that it's not on septic. It does have HOA dues. I'm not crazy about HOA dues because I know that those can fluctuate and things like that. But I would throw out there, I'm open this up since it is, safe space of talking here with my friends here at JWB. Oh, by the way, happy belated birthday to Mr. Dean Curry. Happy belated. One of the things I would recommend that you guys add to this sheet is what neighborhood within Jacksonville is the property located. Because you guys do talk about neighborhoods, whether it's South Side, North Side, I think there's a place, Arlington, and so on and so forth. You've been developing in San Marcos as well. I know where I have one of my properties that has been doing very, very well there. So, and the only reason why I say that now is because we talk about 5 profit centers, appreciation being one of the largest. So the purchase price here is $275. It's up there. It's up there relative to some other JW properties, but it's probably, in line with market and where the other houses are selling for in that particular area. But then I'm always thinking about how much more appreciation can I get over the long term on something like this. And it's probably going to be more if it's in a quote unquote healthier neighborhood of Jacksonville, if you get what I'm saying. And I keep that in mind because of the 6 homes I currently have with JWB. One of them, and only one of them, it's one of them that I bought 4 years ago, is in a not very good area. It's still cash flowing and it's still doing well. The tenants, the residents actually went ahead and renewed their lease for the next 2 years. But when they did, there was not a big rent bump. And it's only because the market where the house is located would not satisfy a big rent bump. Unlike my other properties that have gone through a lease renewal and saw a significant rent bump. So that's the only thing that I would add there. I'm not sure the neighborhood of this particular property, but if it's in a strong one, I'm all in on this house.
That's interesting, man. So one of a couple of things that I'd like to point out, right? When I went through my recent acquisition, right? Like I bought into Arlington, right? Like, and I was very much into, I think like all of us, right? Like we talk a lot about Arlington and the mural and all the cool stuff that JWB is doing there. And I remember GREGG really questioning me on that, right? Like it's kind of a mixture of the two things that Jen and you said, right? In my head, it went into like, oh, I could live in this house if I wanted to because it's Arlington. And then I also thought, it's Arlington. It's got to have higher than average appreciation because of all this cool stuff that's going in. And GREGG kind of took me aside. He goes, it's cool. Like, I love that you bought this house. There was a couple of other reasons, but he told me that really shouldn't be part of the equation because when you actually look at the numbers, right? Like we talk about it often. You mentioned rent increase versus appreciation. You kind of mentioned both of those things, right? Like what they have proven is that all of their neighborhoods have, what was it, Madison? Do you remember the amount higher? It was like 70%.
70%.
Like 79% higher
73,
appreciation. Than the rest of the Jacksonville neighborhoods. And it's all their neighborhoods that they invest in appreciate higher than the rest of them. And then the other idea was like the fact that, and I don't know, maybe we can pick his brain a little further into it. For sure, the idea that it's like, we don't want to be thinking about, are we moving into this home? We want to be thinking of like, is this a well-performing asset? But the idea of getting a higher rent increase, I wonder how that all matches up. Because I know that at the end of the day, when we do the evaluations and you look at the piece of the pie of, your ROI, the appreciation's like Pac-Man, and then like cash flow and debt pay down and taxes is like Pac-Man's teeth. Right. So it's like this like giant piece of the pie. But I do wonder if you have the appreciation constant plus more cash flow, how that compares. And then I would also imagine that it has to do with your particular scenario of like how much cash flow you want today versus how long you're holding.
The thing is, I hear Greg's explanation. It makes sense. That's 73% on average, and that's true. You could probably break that down though, right? And I don't know what it is by neighborhood, Arlington, North Side, South Side. I do not know what it is by neighborhood. But for example, I look at the 3 houses that I bought 4 years ago. A couple of them have appreciated about 55% since I bought them, right? Even though average cycle 4%, Greg's always talking about, but 55%, right? We know that the market has been very strong. The third one only has appreciated 25. I say only 25. That's really, really good too, though, right? So, is this me being a little bit greedy? Yes, but I'm also got to be a little bit mindful for it, because during the same time frame, we all know that our property insurance have gone up significantly. Property taxes has also gone up, maybe not as much as insurance, but definitely so. We can't control the property insurance increasing. We can't control the property tax increasing, but we know that we got to pay it. And so what I've seen is the margin on that home that is appreciated the least has squeezed some. And now that the tenants went ahead and renewed their lease for the next 2 years, only at a $10 rent bump, I was like, and I know my property taxes are going up, my insurance is going up, and so on and so forth. So when we talk about now, what I was speaking about earlier, C3X, well, guess which home I'm accelerating to pay down the most is that home that has appreciated the least, so I can get my margin, my spread back up, my cash flow back up on that particular home relative to where I'm generating on the homes that have appreciated even much more considerably, if that makes sense.
Yeah, makes a ton of sense, man. Really, really great take, dude. Phenomenal. Bob, we haven't gotten to you yet. What's the number one thing that you look at when you're looking at these things?
Well, I think it's probably the same as Herve. You look at the purchase price, you look at, the IRR, et cetera. I would like to mention one thing. Herve was talking about neighborhoods. And, that kind of is a bit of a call for data. Like, how do you know which neighborhoods are appreciating or blah, blah, blah. And there may be better sources of information, but one place you can look is NEFAR. That's Northeast Florida, I think, area realtors or something like that, nefar.com. And it's not too granular, but they will break it out into different neighborhoods, and it'll tell you, for instance, the inventory, the average sale price, blah, 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 4 different neighborhoods in Jacksonville and some of the surrounding counties. So that's a source of information. And again, if someone knows a better one, please tell me, but that's one that seems pretty objective and reliable. That's
great, man. That's great. I just kind of took a note right now, since we're doing these like not your average market insight things, I put a little note of like NEFAR data on neighborhoods versus the JWB data flywheel. Like, I would love to kind of like pit those two things together and see what kind of data we can give. So great feedback, y'all. This was awesome. We already got a bunch of questions, so I'm going to go straight into it. Dean Curry puts in here, I know that IRR is a new calculation JWB is using, but what is the key differentiator between it and standard ROI? Anybody want to take a shot at that one? Explain the difference between IRR and ROI. If not, I'll do it, but I figure that you guys are smarter than I am.
I have personally been trying to understand it better, and I still feel like an idiot. So I'm going to defer to the others.
I'll let
right.
the Wall Street guy do it. Former Wall Street
Oh,
guy.
I was giving you about because you're the businessman and you're in all these businesses. So I figure you're calculating this stuff every day.
In other words, nobody wants to do it, huh?
Well, no, I'll give it a shot, but the thing is, I don't want to come across because I know Greg has defined it, and so I'll run it through my definition, not Greg. So if you guys want Greg's definition, I guess tune in next week or email Pablo. But I think on the ROI, it's money in, it's money in and your money out. Not maybe not money out in regards to the appreciation and whatnot after the first year. The IRR takes into consideration over the life of ownership of that particular property and whatnot, and taking into consideration the cash flow and taking into consideration the sale and things like that. So that I think is the biggest difference there. Greg did mention why why JWB wanted to start showing IRR more than just ROI, and I think it's because taking into consideration or thinking about how investors, they typically hold on to their JWB rentals for a long period of time, that IRR would be a much more valuable metric to measure the performance versus just ROI.
Bob, what do you think of that?
I like him. I think that's a great job.
Yeah. Oh, thank you. Yeah.
Cool. The way that it's been explained to me is IRR includes the vector of time into your equation, right?
Yes.
So ROI is a return over investment calculation. IRR is return over investment with the time value of money factored into the equation. So basically, I'm pretty sure that the reason, so like he even broke it down to me, like because I'm now appearing on other podcasts and representing JWB in it. And I was in there talking about like, well, you got this like 17%, this and that. Cause I was going off of that like Warren Buffett call that we did of like how JWB rental properties have outpaced Warren Buffett's investments in the last like 10 years. And he kind of broke it down. He's like, listen, you gotta think about it, right? So there's a difference in IRR versus ROI when you're buying a home that is cash flowing, that is appreciating at a certain level, and then later on you're going to pull it out versus a home that is appreciating at a certain level without cash flow right now, that then cash flows later, right? So it's a much more, and that takes into account the ability to like reinvest cash that you have in your pocket right now versus cash that you're going to have in your pocket later versus appreciation versus all these things. So it's just a much more involved calculation that includes the time value of money, and that how affects the life of an investment is kind of the way that I understood it, which I think makes sense. It's a more accurate representation. And I'll tell you also, Herve, who was you're into the syndications, right? Like,
Yes.
I think that right now it's pretty obvious that folks are thinking syndication or rental property investing. And this allows you to give it a more apples to apples look at versus a syndication
100%.
as well, because in syndications, they offer it that way, right?
Yeah, absolutely. No, absolutely. It's a great point. I would just add, I'd still lean more towards JWB owning properties, whether it's single families or if you own, duplex, whatever, because now you are in control of the hard asset, right? And all the tax benefits that come with. There's tax benefits in syndications as well, but even more so in owning, the hard asset and whatnot. So it's just, I would love to own even more hard assets, but I have to be very cognizant of my time and my capacity and so on and so forth. So that's where syndication kind of comes into play. Yeah,
makes sense, man. That's very kind of you to express that, right? Like I was just saying, is it apples to apples? But that's cool.
Yeah,
man.
apples to apples, 100%. That's
great.
The IRRs. Yep.
Yeah. Cool. All right. So Lee Bishop says, what does everyone think about rent at over $1,700 with an HOA fee of $500 per year? This is the first property in a long time that has an HOA like that. Who said that they were terrified of HOAs? Was that you, Herve?
Yeah, I'm not crazy. I don't know, terrified is kind of strong, Pablo. But yeah, I'm not crazy about the HOAs, man, because look, I know that, there's going to be fluctuations up to the right on my taxes, on my insurance, and now I got to throw in HOA. And I know that, you guys talked about it when one of your shows, and Greg says, I guess it's JWB that controls the HOA, so there could be a better control of the expenses versus someone coming in and saying, we're going to take up HOAs from 500 to 900 next year, kind of a thing. So that should make investors feel good about investing in the JWB home that has an HOA, but me personally, I just prefer not. I just prefer not. It's, again, you know, I just got to be cognizant of the cash flow. And, you know, as much as we like our residents being locked in for 2 years on rent, you know, because less turns, better ROI and IRR for us and things like that. I think that second year rent up is what, like $50 or something like that. You know, you can have an increase in your HOA that just sucks that away, right? You know, or your property insurance, you know, your homeowner's insurance, something like that. So.
Well, I was about to kick it to Jen, who's got a bunch of properties. I was going to ask if she has
There
an
you
HOA. Bob, but Jen just kicked out of here. Bob, what's your feelings? Is an HOA a disqualifier for you?
It's not a disqualifier, but it's definitely consideration. And so there's a couple aspects to that. One is the financial aspect, but almost more importantly to me is the rules and regs that come with an HOA. Now, some of those are good, right? Because you don't want people in your neighborhood doing crazy things with their houses and putting up neon signs and, you know, whatever. But some of them can be restrictive, you know? So if you're a landlord, for instance, you know, now you own the home, you're a landlord, you have some tenants in there, and say they have some kids that are not the best behaved kids. And say your HOA has some restrictions in it that says, oh, we have the right to approve all leases and we can kick out tenants with 120 days notice if we don't like the tenants because, you know, their kid misbehaves. I mean, that's a factor, right? So HOAs, you have to kind of look at what the rules and regs actually are in the HOA and see that those are going to be acceptable to you.
Yeah. And I think Chris Gonzaga is asking like what comes in that HOA. I can't really answer that without GC here. And I don't know if he would be able to answer that either, but that's definitely something that you can talk to the team about when you're looking at one of these properties. To recap on kind of what Herve mentioned, we had a previous call where we dove a little bit into the HOA topic, and the majority of these properties that JWB offers that has an HOA, it is a homeowners association that is populated by other investors from JWB. So you kind of control the interest. And what he broke down is that like an HOA that is really like concentrated on someone that doesn't know real estate value and is just like trying to like add things that they want to use, like a pickleball court or something like that, which I'm in, is very different than an HOA that's controlled by a real estate investor that understands comparable other living scenarios and what is a competitive advantage when it comes to renting out a property. So I think it's also something to consider. But yeah, I can definitely see how there is a vulnerability. Jen, you got a bunch of properties with JWB. Do you know if any of yours are HOAs, or if you have any feelings about HOAs?
None of my properties have HOAs, but I will say this, I am a renter in Monterey, and the price and the HOAs they don't scare me at all. Think about it. There are a lot of people coming from other states that are more expensive than Florida, moving into the Jacksonville area. And that rent is low, in my opinion. I'm sure other people would argue, but what we're paying here versus over there, and it's going to have nice upkeep. And there's going to be like, I'm assuming with an HOA, not only is it covering insurance, but it might also apply to the landscaping of the common property. So I'm thinking not a big deal to me, as long as the IRR and the ROI pan out. And I know I'm going to hold on to it for a long time, and I'm going to have happy renters. And by the way, I'm going to go back and defend my statement that all JWB properties are cute. Okay, yeah, you don't want to be buying on emotion, but let's look at it. The renters that you want nice curb appeal. And so the fact that the numbers look great for the investors, but then the houses also are appealing to the tenants, that's a win-win. And that's not something you get with every turnkey rental and property investment company. They actually have a holistic approach of making it look adorable and making it cash flow. So win-win.
You're right, Jen. You're right. A couple of really good points. Number one is like, you got to think from the the main point that I heard you say that's pretty profound is like thinking from the standpoint of the renter, right? Like, yes, curb appeal is important to the renter, to the resident is what JWB calls them, right? The other thing that you're saying is very true. I'm used to coming from Miami, having an HOA of $500 a month, right? Like not $500 a year. And with this influx of people that are moving here from other places, I get exactly what you're talking about, right? So, all right, Pedro, says, I think the appreciation rate is set to 0 during this presentation, or am I remember that incorrectly? Pedro, we used to have it at 0. Now that they're doing the IRR, it is included in this calculation. So that is a good point. They used to set it at 0, and then we used to do a magic trick at the end that shows the beauty of leverage. But for all intents and purposes nowadays, we're just throwing it in there so you can make a good decision. All right. So Marilyn Cotterman from Homosassa, Florida, is asking, don't you have to refinance to take equity out that you might have in a rental home? If my interest rate is really low right now, I wouldn't want to refinance now with higher rates. That concerns me. How about you? Thoughts?
Yeah, I think she's 100% correct. I mean, you typically want to refi from, a higher rate down to a lower rate. So you pull cash out, and the new debt that's going to be put on that property that you just refied is going to be, much lower debt, right? So that's going to help increase your cash flow once you put that new lower debt on your property and whatnot. Now we're in an environment where it's obviously been reversed. If you bought your JWB home over the past couple of years, you probably bought it, at a very low rate if you use conventional financing versus non-recourse. And so, you try to refi right now, like you said, it's going to be at a higher rate. The only time it could make sense to go ahead and refi, even though your interest rates are higher today than they were years ago, not just 2 years ago, many years ago, is because you've built up so much equity in the property that, the cash that you're taking out, it's going to be enough for you to go ahead and put a down payment on another JWB home. And you still, now you have, very few years left on the home that you are refinancing because you had so much equity built in, if that makes sense, right? So, but you got to do the math on it. It's not automatic. You have to do the math on it, because at the end of the day, you don't want to have a bigger mortgage payment after you refi than what it was like before you refi, if that makes sense.
Yeah, that makes sense. Anything to add there, Bob or Jen?
Yeah, just a little context on interest rates. So yeah, if you look back 6 months ago, for conventional financing, it was probably ballpark, 3% loan. And now it's probably 250 basis points above that. So, I mean, I don't know today, but maybe it's 5 point something percent, which sounds high. But if you put it in a longer term context, I think the average over the last 50 years has been something like 7.7% interest rates. Right. So you put in that context, you say, well, 5.5% is not so bad in terms of, making the numbers work. So, we're a little fixated on what was an extremely low interest rate, a year ago. And now it's trending a little more towards normal.
Normalcy.
Yeah.
Yeah.
No,
That makes a lot of sense.
We've been spoiled the past couple of years.
Yeah. Also, too, I remembered Greg having a conversation with us in a previous podcast where his interest rates were 7-8%, and he was still making money off of it. So as long as the math works out, it's going to be fine. And remember, we're holding on to this long term, right? So the rents are going to catch up, and I don't panic over it.
Makes sense. I was going to say, Marilyn had a question here of like, can you get cash out without a refinance? Have any of you done any of that without refinancing? Like
that would work.
a HELOC or something like that? Would that, I don't know if that's available anymore in these types of like rental properties, but I don't know.
I would love to hear. I tried to get a HELOC on one of my JWB properties, wasn't allowed to do it.
Okay.
Bank pretty much told me we don't give HELOC on investment rentals. So
Yeah, I've heard that.
Other folks have had success with different lenders, but I haven't been able to.
Okay. And Drew, Ringmaster, he's saying you can get a second, and I'm researching investing in HELOCs right now. So Drew will probably come back here and in a call in the near future with his amazing researching skills. The other thing that I heard too was this idea that this interest rate thing right now is temporary, right? Like right now we got rates going up like crazy and they're going to come back down at some point, right? So this idea of like getting in, starting to benefit from the 5 profit centers of debt pay down and appreciation and tax benefits and a little bit of cash flow, maybe like 3-4 years, interest rates are lower today than they were. Probably not in the near future, but in like 3-4 years, they are. And at that point, you're able to refinance and do those kinds of things. So like, I have heard that. I don't know how much that holds water. All right. So we got Bill Oxley. We got a question from Facebook because Madison the Magnificent is out there monitoring everything. Bill, we know that you tune in Facebook. Appreciate you, man. Thanks for sending in a question. He's got a question for the panel here. And he's asking, if you can do anything different, if it was just one thing, what would that be? Let's start with Bob. Why don't you kick us off?
Start earlier. I mean, so, the best time to invest in real estate was yesterday or 10 years ago or 20 years ago, whatever your thing is. So, yeah, I mean, a lot of this comes down to simple laws of, compounding interest and whatnot, and whether it's in stocks or whether it's in real estate or whatever, get in and let your money work for you.
Jen, you're with us before you get knocked off again. What would you do different? We lost her. Herve, you're pinch hitting. Let's go.
I'm pitching. Hey man, listen, I got to reiterate, Bob, to be honest with you, because you can't control the price, you can't control the interest rates, right? But what you can control is the time that you decide to invest in real estate. So, and so if you start earlier, right? I mean, I would have bought as much as possible a long time ago. And if I didn't have the capital, then I would have been banging on my doors of my families and friends, like, give me your money, give me your money. Because we need to go buy real estate. We need to buy as much as we can today. So yeah, that's I think is what I would have done differently. Probably would have come to check out the properties before I purchase. I mean, like I think a lot of JWB investors, I did purchase sight unseen. I'm up here in New Jersey and whatnot. Nothing wrong with how the purchases went, but I just felt, a little risky putting down as much as I did and buying the home sight unseen and whatnot. But again, I've done a lot of work and research on JWB before I went in and did that. But if I would have done something a little bit different, maybe I would have picked this home over that home. But at the end of the day, JWB would have been managing it. Maybe the numbers on some homes would have been better than others. But at the end of the day, still can be happier.
Okay, that makes sense. Jen, you were coming up with something before the man knocked you out.
That's okay. So yeah, getting my real estate license and keeping my real estate license, I had to go take the test again, and it was hard. But I will say, yeah, I could say that I could regret that I didn't do things better, sooner, faster, what have you. But honestly, I think I did everything perfectly because I needed to have the education. And shout out to this show. I needed this show to feel smarter and feel more confident. So the timing was perfect.
Well, timing is perfect. Drop a great compliment and then you bounce. I'm in.
Oh, man.
That'll work. Well,
so well.
That's a great piece of advice from Jen. This idea of like getting a real estate license and getting as much education as early as possible. Bill did challenge y'all, saying he's heard start early. Herve, you had to maybe come visit properties, maybe take a little extra trip down here. Bob, do you have anything different outside of starting earlier that maybe you could think of?
Well, it's a very personal thing. I probably would have been a little more aggressive in using leverage. By my nature, kind of a conservative person. So I like to not owe people. So I've been very reluctant over the years to take loans and whatnot. And I think using a little more leverage would have probably helped me a lot over the last decade. But
yeah, that's a good one, man. That's a good one. And I'm gonna go right back to kind of what we were just saying. Raul's got a great question. And I'm going to add context to it, right? He's saying, everybody's saying start earlier, but it's pretty easy to say start earlier when 10 years ago, there was more cash flow in all of these properties, right? So like Raul is asking, are the panelists still considering investing these days with little cash flow, like little to no cash flow? Are you still considering it? Jen, you're nodding your head and
I'm so into it because here's the deal. Jacksonville market is still super affordable. Like compare Jacksonville to Monterey. I live in a duplex that's 1.3 million and it's a shack. It needs like $250,000 worth of rehab. Okay. And you can buy a property in Jacksonville for 200, 300K and still get return on investment. Yes, please. More, please.
yeah, that makes sense. How about y'all? How about you, Bob?
yeah, I would still invest in real estate. I mean, I might change what I look at a little bit more, but if you have cash, the problem is cash is sitting and inflation is 9%. It's if you put your money in a bank, you're getting less than 1%. So you're just losing money all the time. So placing that money to work for you in real assets to me makes sense. So I wouldn't necessarily bank on, great appreciation. That's to me is like a bonus at this point, but just solid real estate that you're willing to hold for fairly long period of time. Don't, unless you're going to be an active flipper and have a plan to do it in 6 months or something like that and get in and out of a property, plan on holding it for a while. I think you'll do great.
Makes sense. Herve.
Yeah, I would. I was trying to remember the question, but yes, I would still get in. Like I said before, I think we were talking earlier, I don't like to try to time it. I would have to give more credence of trying to time when I'm getting into the stock market versus getting into real estate. I really don't think there's a bad time to get into real estate. Interest rate increases do not scare me at all. Property prices can rise and fall regardless of what's going on with interest rates. If I'm going to be hesitant about getting into real estate at any particular time, I got to watch supply and demand. That's what we do not have going on right now, oversupply relative to demand versus what took place back in 2008 that caused so many property prices, obviously, just to fall off a cliff so quickly across the country. So we are not anywhere near that right now. I don't expect that we're going to be. And so 100% I would get into it right now. With, like Bob was saying, plans on holding on to that piece of real estate for a very, very long time, not flipping it.
Makes sense. And Raul, what I can tell you, man, is as somebody who just bought a property, right? Like, so obviously my de facto answer is yes. What I looked at, and I bought the most expensive property that I've bought so far with the least amount of cash flow, right? Like my cash flow is like sub $50 a month on that one. And I kind of go back to what Jen is saying, living here in Jacksonville, it's pretty obvious that this place, you look at all the statistics, you look at all the numbers, you look at the ULI kind of like supernova city report or whatever. I can definitely tell you that people in Denver, if they would have given a chance to buy a rental property in Denver 5-6 years ago, maybe 10 years ago, that was at like break even cash flow, they were being asked, would they wish that they had back then to today, given all the socioeconomic development that's happened there? I'm pretty sure they'd be like, heck yeah. So like, to me, I look at this idea that I can break even in the short term and buy into a macro economy that is just crushing it right now and only going to get more expensive and things are going to be much harder to get into later on with the same kind of like unit economics. That's really why I did it. So I that's the best advice I can offer. I don't know if you guys think all that makes sense or not, but I feel like you guys are more seasoned investors than I am. I'm all insecure over here. All right. So before we get out of here, I wanted to just I wanted to ask the question that as a marketer, I'm always most interested in, but like, what is the thing you're thinking about the most right now? Like, what are you most scared about? What worries you? What is the biggest opportunity out there? Jen, I'll start with you since you're with us for now.
I know, right? Okay, so I own a marketing agency. I work with various industries, predominantly the auto repair industry, which was recession resistant, also construction and dental. Those are the three big industries that we work with. Every single industry is seeing interesting things happening. Auto repair continues to be recession resistant, but my construction and remodeling friends, things are slowing down and they're nervous. Although I will say this, there's a lot of hype on the news about the sky is falling, the sky is falling. So Chicken Little is, running around making us all panic. I highly recommend this book. Prosperity in the Age of Decline by Brian Bilyeu and Alan Bilyeu. Get this book, read it. These are economists that own ITR Economics. Their accuracy rate of predicting what's going on in the economy is 94.7% accuracy. And they are predicting what is happening in this decade. And what is happening right now, and I pay attention to their stuff very closely. Yes, we're going to have a soft landing. It's not going to be hard, but I'll tell you, 2030 is when the shit's going to hit the fan, pardon my expression. But the point being is that, yes, do the C3X method if you wish to hold on to your money and pay down all those mortgages so you can make sure that you are debt free by 2030. And just to let everyone know, the reason why I want to be a real estate licensed individual is I would love to get into the property management side here in Monterey. I'm sitting at the feet of the best with Greg and Pablo every single week, right? Learning how it should be done. And I'm seeing poor, because I'm a tenant, I'm a renter, and I'm seeing poor customer service. And I want to show them on this community, in this community, what excellent customer service and the way things should be done. So that is my motivation as to why I got my license. And
Awesome,
I'm just
Jen.
excited for the future. I'm really not worried. Yeah, I'm cutting back my expenses. Yes, I'm saving my money. Yes, I'm being smart with my money, but I know that I'm going to have money to invest when a downturn happens.
Awesome. Great answer. Great answer. And I'm definitely picking up that book. Definitely something to say about the whole like roaring 20s happening right now. But then what followed the roaring 20s was a kick in the teeth, as I think you said. What about you, man? What's your, what are you most thinking about these days? Good or bad?
So I don't think I'm worried about anything, but I'm kind of monitoring and mindful of the macroeconomic situation, and that might lead me to some opportunities. But I'm just trying to kind of stay within my plan, and I allocate resources in a certain way. Just roughly speaking, a third to stocks and bonds, a third to real estate, and a third to other, meaning cryptos, precious metals, whatever, other stuff. And, so there's some, fluidity between those, but I try to keep it within the plan. And I think that long-term that'll work out.
Love that. Very, very even keeled answer, Bob. Appreciate that. Herve, how about you, man?
Listen, at the end of the day, I'm also, keeping an eye on the trends and trying to read tea leaves and so on and so forth, not try to forecast too much ahead. But so Jen, thanks very much for some of the data points that came out of that book and whatnot. But listen, I am, at a point where I've been very fortunate and blessed to have made more right decisions versus all the wrong decisions that I've made over my years of investing and so on and so forth. So at a point right now to, I'd rather not focus on my concerns as much as concerns of other people. And so I'm really trying to focus on the educational side of real estate investing to teach those that haven't been able to benefit, that are suffering a heck of a lot more than I am, than I think a lot of us on this call, to get people to get invested in real estate one way or another. It's typically women and people of color that have been left behind when we've seen so much growth in real estate over the past several years. So is there a way that, the little bit that I can do just to educate, to teach people early on that they should get started early. And there are ways to do it, even if you're going to do it, if you're not going to purchase a hard asset, that you go passive, or if you go to hard asset that you don't have to manage it, you go with a turnkey provider such as JWB, right? So there's just a lot of people out there, Pablo, as I'm sure you know, that just don't know about turnkey investing, let alone know about JWB. And what if, just through education and through talking and paid classes, I mean, literally just talking to people and explaining to them, hey, listen, could be really, really opportunistic, really mind-blowing. If you learn about investing in real estate, it's not calculus, it's not trigonometry, but that you can set yourself up and your family up, generations for years and years to come. So that is I'm concerned for those folks, and that's why I'm focused on, providing education and knowledge to those folks.
I love that, Herve. I remember that takes me back to our conversation at Ruby Beach Brewing,
exactly.
Of what you were trying to do, man. I think it's really, really cool. I'll tell y'all, I just got back from, as we wrap up here, I got this new client who's a financial advisor only to physicians, only to doctors. And I just spent the last 3 days talking to like 12 doctors, just like interviewing them, getting to know them and stuff like that. And all of them were like, I feel like I started late. I feel like I have this like guilt that I started late, and, we came out of school with all this debt and all my friends had done all these other things. And kind of, it was incredible to hear from them, all that stuff. Cause I feel like we all feel that way, right? Like it's not just doctors. Yes, they all have it in one particular way. And then they have this like big cash stream that ends up happening that provides a path forward. But we all kind of feel like we all started late. And we all we all wish we would have done it sooner. And hindsight's 2020 for everybody. But to your point, this education thing is real. That was the other thing, is like all these misconceptions of real estate that are out there as I research what to speak on more and more on this show. So I love that, to be able to share this panel with you all, who all come from different backgrounds, different points in your life. And we all kind of feel the same way of like education forward, taking action, like keeping your head cool. Even though we're headed to a decline, there's opportunity, keep your head on straight. And it just really means a lot to get to share this with all of you. So I'm just really, really grateful for you, Herve, you, Bob, you, Jen, for taking time to come on here. Super, super grateful for the community, for the great questions today that really drove the conversation and allowed you all to shine the way that you did. Really awesome. And just, I never take it for granted that whether it's you or the rest of our community here that shows up, that you take an hour of your day on a Thursday to come here, ask great questions, get educated, like be a part of this thing, joke around with us some, right? Like maybe make fun of me if you really, really want to, which I really like. And if you're listening on the podcast, if you listen on the podcast, I'd love it if we're trying to reach more people, right? Like if you can just share a YouTube show or a podcast episode with one of your friends, that would really, really mean a lot to us. But we'd love it if you haven't joined us to come to nyais.com, be a part of the discussion, and maybe get a nickname if you play your cards right. Who knows? So thank you so much, all of you. On Tuesday, GC is back. We're going back to our Not Your Average Investor Insights. We got some big stuff to talk about. We're gonna get into this idea that Wall Street's buying up all these homes around Jacksonville. Is it good or bad? Is it good or bad? You never know. But I'll give you each a sign off. Give me a goodbye to everybody. Leave us with something. Herve, I see you biting your lip. You can go first.
Oh, hey, listen, man. No, Pablo, thanks so much for having me on, man. It's always a great time, whether I'm coming in as a panelist or just a listener on this show, man. It's so much fun. The questions, the back and forth. We got some bright, some smart heads up in this show. So, I like to learn. I like to teach back and forth. I feel like I'm 50-50 on each. So this is always fun. You never know what you're going to get, which is why you got to tune in, because you never know what you're going to get. So that's awesome. So I appreciate it. Thanks. I hope you guys all benefited today.
Awesome. Jen, before your technology cuts you off, you can give us a goodbye too.
You all know I love this community so much. And our next Monterey meetup happening August 20th during Monterey Car Week. So if you love cars, if you want to hang out with your people here in Monterey, come play with us. It's going to be awesome. Contact me if you want to come. Love that. Bob, give us a goodbye here.
Hey, it's been fun. Thank you. And special thank you to you, Pablo. You did a great job minding the store while Greg's away.
You know what they say? They got the inmates running the asylum out here. So, if you guys want to run an asylum one day, just make sure you just can't be average. I'll see you on the next one.